Welcome, my name is Vishal Tekshanani. Today I'm speaking to Kevin Gallagher, the CEO of Santos, and we're going to focus on the energy company's capital expenditure and capital allocation plans following its 2017 results. Kevin, great to have you here. How are you?
Thank you, Vishal. Great to be here. Looking forward to it.
Excellent. So Kevin, the media's well and truly covered your 2017 results. So why don't we frame the question from a longer term perspective? How do you feel about where Santos is today compared to where it was a few years ago, and are you happy with that turnaround?
Yeah, well, look, I mean, if I go back as far as early 2016, the company was losing $2 million per day in free cash flow. And if you contrast that with where we are today, that's a turnaround of $1.4 billion over 24 months from the same asset base that we had back in early 2016. So from that perspective, I'm delighted with the progress we've made in the turnaround. In addition to that, our underlying profit has increased by 433% to $336 million. Our net debt has reduced 22% to $2.7 billion. And we've delivered $618 million in free cash flow from our operations. So when we look at all of that in aggregate, as a business, we've strengthened our balance sheet, we've delivered a disciplined operating model, we've reduced costs right across all of our operations, and we are now the lowest cost onshore developer in Australia. So that's a lot of progress in 24 months, and I think we've now positioned the company to deliver significant value to our shareholders going forward.
Okay, so let's focus on that free cash flow, and I want to tie that into capital expenditure. So one analyst I spoke to remarked that free cash flow looks really good because you've been spending less money on drilling oil wells. And as a consequence, your reserves profile has deteriorated. So do you think that's a fair comment? And what would you like to tell shareholders about where your reserves stand?
Well, first of all, I don't think our story is a cost out story. This is about a cost and efficiency story. So in actual fact, we've increased the number of drilling operations, the number of wells that we're drilling across our operated assets. In the Cooper Basin, for example, in 2016, we were planning to drill 37 wells. And this year we'll be drilling between 70 and 80 wells for a lot less capex. Likewise in GLNG in Queensland, where we've ramped our drilling up to 250 wells in 2018. And that's designed not only to increase our production across our operated assets, but also to bring reserves back to book in the longer term. If I look at the reserves recovery or reserves replacement ratios for our business, for a number of years Santos has added no reserves. Indeed, it's been negative as we've written off reserves through the oil price decline through 2014 and 15 in particular. In 2017, we've arrested that trend. And so in 2016, our reserves replacement went to 19%, which is way below where our long-term target is. In 2017, that's increased to 62%. So that trend is up as we increase the number of wells we're drilling. And I hope to continue that progress over the next few years as we continue to drill more wells, increase our production, and increase the ratio of exploration wells across that drilling portfolio.
Okay, so let's focus on capital allocation. Sure. So I think shareholders have really brought into the narrative that Santos has turned around, the balance sheet's strengthened. So I think they're now looking for direction from you in terms of what are you going to start doing with this free cash flow? So I'd like you to answer that question under three different situations. Number one, if the oil price stays where it is today for the next several years, let's assume that. Number two, if it goes down significantly. Number three, if it goes up significantly. And if you can talk about the likelihood of the dividend being reinstated and how soon under either of those situations.
Okay, Vishal, that's a lot of questions, but let's go. Let's see if I can address them. The oil price scenarios are irrelevant, and that might sound strange for a resource company, but we've positioned our company to be able to fund its activities in a $40 oil price environment. And we set out back in 2016 and said that we believed the low point of the oil price cycle was between $35 and $40 US. And therefore we needed a business that could perform all of its sustaining activities, sustaining capex activities within that oil price range, so that when the oil price drops, we wouldn't find ourselves doing what we had to do in 14 to survive, and that is cutting activities, which ultimately then leads to declining oil production and declining revenue streams, and it becomes a very self-fulfilling prophecy. Today, what I can tell you, much quicker than I would have anticipated back in early 2016, we have positioned the business now so that we are able to drill between 70 and 80 wells in the Cooper Basin. And the Cooper Basin is free cash flow positive at below $40 US. Back in 2016, the Cooper Basin required $72 US oil price just to break even. So that's an amazing transformation. And we are growing production at the Cooper Basin at the same time. If I look at Queensland, we're now drilling 250 wells this year in Queensland for a GLNG project, and we're ramping up production at the same time, and it's free cash flow positive at $40 US. And all of our other assets in our core portfolio are able to perform their exploration and production activities while still being very free cash flow positive at $40 or less. So our entire core portfolio now is set up to provide us with a flat production profile to beyond 2025 and be free cash flow positive somewhere between $35 and $40 oil price, which we believe is the low point of the cycle over the longer term. What that means and what our value proposition to shareholders is, therefore, is that as the oil price increases above $40 oil price, that is all margin increase for us. We're not allowing our cost structures to follow that. We're capping our cost structures by maintaining free cash flow positive outcomes on all of our assets at the $40 mark. Now, in terms of guidance, what does that mean for shareholders? That means that for every $10 that the actual oil price is above our free cash flow break-even price, which this year we are forecasting as being $36, we will deliver between 250 and 300 million US dollars in free cash flow. And to put that in perspective, if you look at the average oil price over the last month or so, it'd be around about $66. And that would deliver, if that was the average oil price for the year, that would then translate to a free cash flow outcome somewhere between 750 million to 900 million US dollars in free cash flow. That is the best kind of description of what the transformation in our operating model has delivered over the last 2 years. And what that has meant is that we've been able to generate significant free cash flows from that same asset base, also from the sale of non-core assets, which has allowed us to pay down debt. We set a debt reduction target at the end of 2016 to get our net debt to around $2 billion by the end of 2019. We're now at 2.7, so we're way ahead of plan, if you like. And if oil prices maintain, then what that would mean is a likelihood that we'd get there anywhere up to a year, possibly even more than a year early against that target. And so undoubtedly that what that has meant is that the board, and dividends are a matter for the board, the board has turned its mind to start to think about the options for returning value to our shareholders. And over the course of the next 6 to 9 months, we'll be doing a bunch of work on various capital management strategies to determine the best way to do that.
Okay, so would it be fair to say a dividend's coming back sooner rather than later? Or
I think it's fair to say that we're looking very seriously at how best to return value to our shareholders, and that the date for which we thought we'd be able to do that is coming forward quite rapidly. Of course, that is dependent on our oil prices and our ability to keep generating these free cash flows.
Okay, so last topic on asset sales and M&A. So there's been media reports about Santos having put its Asian business on the block. Is that true, and where's that at? And any other M&A activity you possibly looking at following Harbour last year?
Yeah, well, okay. Well, I mean, I always think that's a fantastic question, because the thing about M&A, if you were looking at it, you could hardly talk about it publicly until you have something to announce. But however, what I will say, the Asian assets, when we rolled out our strategy to the market in December 16, we said then that we were separating out our non-core assets and running them separately. And the statement we used was running them separately for value. And what we meant by that was, and what we meant by non-core, indeed, was that when it comes to capital allocation, the core assets have priority. Other than commitments that we can't get out of, that our focus on capital allocation would be to invest in our core assets, because these are all long life assets with 20+ year lifespans in front of them, and the non-core assets therefore would be at the back of the queue. We'd run them separately, we'd run them efficiently, as low cost as we can, and maximise the value from them. However, if someone was interested in those assets, then obviously we would consider that as a means to, I guess, deliver those cash flows early through sale. What I can say about the Asian assets is they're great assets, have performed fantastically well over the last couple of years, delivered very significant cash flows, and we have had a lot of interest in those assets. And today, it's fair to say that we've got some advanced discussions with a number of parties who are very interested in taking these assets, and for them these would be core assets. So for the folks working on those assets, that's a really important point to make, because what that means is we'd be if we do decide to sell them, we'd be selling them to companies who want to invest in these assets and develop them further. I expect that we will be in a position over the next few months to finalise that process, and obviously if it results in a sale, we'd make an announcement then.
Okay. Kevin Gallagher, thank you so much for coming in to speak to me and coming to speak to NAB Trade investors with shareholdings on your company. I think that was tremendous insights on what Santos is up to.
Okay, thank you very much.
I hope you found this video informative. Please remember, what we discussed today isn't a stock recommendation. If you're thinking about transacting in Santos's shares, please do your research, think about getting financial advice so that you can get the help in making a decision that's right for you. My name is Vishal Tekshilani, and I'll see you next time.